If you've ever traded crypto, you know the feeling, right? You buy an asset, and the price to sell it back is instantly lower. It almost feels like a trick, but that gap, it isn't a glitch, it's a core feature of every single market out there, and today we're going to demystify it. We're talking about the bid-ask spread.
So yeah, it's this weird story of two different prices for the exact same thing at the exact same time. It seems confusing at first, I get it. But honestly, understanding this one little concept is the key to figuring out how all markets really work under the hood. I mean, really think about it for a second. You hit buy on a token, and a moment later, the price you can sell it for is already lower, even if the market hasn't budged at all. So what's going on there? Well, that little gap, that mystery, is exactly what we're going to break down right now.
Okay, so to solve this thing, we need to introduce the two main players in every single trade. On one side, you've got the bid, and on the other, you've got the ask. Think of them as two sides of the same coin, constantly in a little tug of war.
At its heart, that's all a market really is. It's just a place where buyers and sellers come to meet. The bid and the ask are basically just the official terms for what each of those sides is trying to do.
And here's where it all starts to click. These two prices are basically opposing forces. The bid is the absolute highest price a buyer is willing to pay. And the ask, that's the absolute lowest price a seller is willing to let their asset go for. It's a nonstop negotiation happening millions of times a second.
Let's just focus on the bid for a second. If you own an asset and you want to sell it right this instant, the bid price is what you're going to get. It represents all the demand out there in the market. It's what buyers are offering in real time.
And then, on the flip side, you have the ask price. If you want to buy an asset right this instant, this is the price you're going to have to pay. It represents the available supply. It's the lowest offer on the table from anyone who's selling.
Okay, so now let's bring it all together. We've got the price buyers want, and we've got the price sellers want. The real magic, and frankly, the hidden cost of trading. It all happens in that little space between them.
See, this difference isn't just some random gap. It's a super important indicator of the market's health, its liquidity, and it's also how market makers make their money. That little gap tells a huge story all by itself. And there you have it. That's the answer to our original mystery. That gap between what buyers are willing to pay and what sellers are willing to accept is the bid-ask spread. It's the simple reason why the buy and sell prices are never exactly the same.
Let's make this super concrete with some numbers. Let's say you want to buy some crypto, and the ask price is $22. But if you wanted to sell it at that exact same moment, the highest bid is only $20. That $2 difference, that's the spread.
Now, the size of that gap is a huge deal. A tiny or narrow spread is a fantastic sign. It means that market is healthy, it's liquid, and there's tons of competition. But a wide spread? Ooh, that's a red flag. It points to low liquidity, and it means every trade you make is going to be more expensive.
So that begs the question, right? What makes a spread wide or narrow? It's not just random. The spread is always reacting to the market, so let's look at the actual forces that are pulling the strings.
It pretty much boils down to three big things. First, you've got volatility, how much of the price is swinging around. Second, there's liquidity, how many people are actually buying and selling. And finally, the engine behind everything, good old supply and demand. So, when a market is just going wild, with prices jumping all over the place, things get risky. The market makers, those are the folks or algorithms facilitating all the trades, they protect themselves by widening the spread. That bigger gap is basically their reward for taking on all that extra risk.
And this one is just common sense, really. If you're trying to trade a less popular, maybe more obscure asset, there are just fewer people around to trade with. That makes it way harder to find a buyer and a seller who agree on a price, so the gap between them, the spread, just naturally gets wider. All right, so we've got the definitions down, and we understand the forces at play. But how do we actually use this stuff to become smarter traders? That's the important part. I mean, this is the million-dollar question, isn't it? We know that narrow is good and wide is bad. But how narrow is good? What should we actually be looking for when we're about to make a trade? Here's your benchmark, the rule of thumb you should keep in mind. A good spread is narrow. We're talking just a few cents or tiny fractions of the asset's price. If you see a spread that looks really significant, you should treat it like a warning sign. It probably means the market is illiquid and your hidden trading costs are about to be pretty high. So, this is your new trading edge. You start looking at the spread as a powerful tool.
In just one glance, it tells you how healthy the market is. And even better, it tells you, before you even trade, exactly what your hidden cost is going to be to get into and out of that position.
And that's really the whole ballgame. The spread is no longer this invisible, mysterious force. It's a visible, measurable piece of data you can use. So I'll just leave you with this one thought. Now that you know what you know, what are you going to be looking for before you click that next buy or sell button?